Hello guys. So we've completed 2 sessions in transfer pricing, and what have we seen so far? We've seen 3 sections to be specific, or 4 sections: section 92, 92A, 92B and 92C. So what was section 92 about? Section 92 brought us to the introduction of transfer pricing. It gave us 3 components which were necessary for transfer pricing. Component number 1 was definition of associated enterprises, which was done via section 92A, and then the second component being international transactions, which was defined in section 92B, and third was these transactions should be at arm's length. So this arm's length was defined by section 92C. So 92A listed out certain scenarios which would constitute associated enterprises. So we had taken the example of Acer India Private Limited and tried to identify all these scenarios one by one. Then when it came to section 92B, we saw that transactions would be constituted as international provided there is at least one non-resident in that transaction. Whether both the parties can be non-resident, yes, then also it will constitute a non-resident or international transaction. Then we went on to understand that there is also something called as a deemed international transaction, which happens between an associated enterprises and unrelated party, where the terms are dictated by another associated enterprise. Now, apart from this, we switched over to section 92C, where we understood that there are 5 methods which are prescribed for the purpose of ascertaining arm's length price. What were the methods? Comparable uncontrolled price method, resale price method, cost plus method, profit split method, and finally transaction net margin method. These methods were described in Rule 10B of income tax rules, which told us as to how to approach about finding out the arm's length price. On top of this, there was the 6th method also, which is the any other method prescribed covered under Rule 10AB of income tax rules, which is not specifically defined because it is tailor-made based on scenarios which cannot be covered under any of these 5 methods. Okay, so what was this comparable uncontrolled price method? This method would apply whenever there is a comparable uncontrolled transaction which can be compared with your related party transaction, and then you would go ahead and make any functional differences between these 2 transactions to arrive at the arm's length price. So you always start with the uncontrolled price and then arrive at the arm's length price. So this was comparable uncontrolled price method. Second method was your resale price method. When would this apply? When I purchase from a related party and sell it to an unrelated party. Okay, so this what happens at this method. We start off with the final sale price, that is the resale price is the starting point, and then we account for the normal gross profit margin. What is the normal gross profit margin? When I purchase from an unrelated person and sell to an unrelated person, what is the gross margin I make is called as normal gross margin. This normal gross margin is removed from the ultimate selling price, and then we arrive at whatever purchase related expenses that are available with us as a deduction, and then conclude with whatever is the arm's length price. So how is the arm's length price computed? You take the resale price, remove the normal gross margin, remove the purchase related expenses, whatever is the balance that is left over becomes your arm's length price. And wherever you have arrived at arm's length price and it is different from the transaction price, you will take the difference as the additional income that has to be accounted for by the assessee. Suppose the arm's length price is lower than the transaction price. So what are we trying to tell? The transaction price is 100, arm's length price is 80. In this case, forget about application of transfer pricing, because the very thumb rule for which we are working right now is to protect the interest of revenue. When the transaction price is 100 and arm's length price is 80, already the interest of revenue is protected. You don't have to do anything and try to harm it. So that is why we ignore such kind of application. So wherever the transaction price is greater than arm's length price, we will always accept the transaction price and go forward. We will not try to adapt or change it. Or other way around, if the purchase price that the assessee has accounted for is 80, whereas arm's length price is 100, now you will not go and adopt it as 100, because if you take 100, purchases will go up, profits will come down. But the assessee himself has been honest in accepting the lower price, therefore you will accept with whatever the assessee has done and not apply transfer pricing provisions. Now the third method that we saw was cost plus method. So when does this method apply? When resale price method cannot be applied, and when comparable uncontrolled transactions are not available, we go for cost plus method. So what do we do there? We ascertain what are all the direct costs and indirect costs of production, and then to this we add the normal gross margin. So what is the normal gross margin? We try to take unrelated transactions, we try to see what is the revenue from such transactions, what are the costs from such transactions, and we arrive at the gross margin. This gross margin is added up to the total cost to arrive at your arm's length price under the cost plus method. Now, the next method that we saw was profit split method. Under profit split method, what did we tell? When there are joint ventures from 2 or 3 associated enterprises which combine together for a joint venture, they generally have terms based on which they define their contribution ratio, and this contribution ratio is used for what? It is used for profit split. So how do they split profit? First they identify the total revenue of the venture, and then the total cost of the venture, they arrive at the profit. This profit is split in the contribution ratio. Okay, so this is the contribution split method. Now, on top of this, what do? They add the cost of production of the Indian entity or the associated enterprise in India along with the profit share of the associated enterprise in India to arrive at the total price which is to be charged. Now, in this case, what happens? Suppose the transaction price is going to be lower, that is the actual revenue allocation is going to be lower than the arm's length revenue, then we will have to go ahead and make a transfer pricing adjustment in that regard. Now, there is also one more method that we discussed here, that is the residual split method. What do we do there? There is a defined basis of splitting the profit that is to be done. So what do? They tell that, for example, there has to be remuneration given, or probably interest on capital that has to be paid, or probably contribution up to 60% or profit up to 60% will be split in the ratio of the contribution ratio, and the residual profits will be split equally, or residual profits will be split based on the amount of work that is being done by each co-venturer. So this is called as residual profit method. Now, the last method is the transactional net margin method, where we try to ascertain the net margin of comparable companies or competitive companies, and then try to reduce it from the price to arrive at the cost to be charged or the revenue that has to be claimed, and accordingly make an adjustment. So these are the 5 methods we have seen yesterday. Then we went on to see one more section, section 92C2. What was this section talking about? Suppose by applying all these methods, these 5 methods we have been talking about, by applying these 5 methods, suppose we arrive at multiple prices. That is, we don't arrive at one arm's length price, we arrive at up to 5 arm's length price. So we arrive at up to 5 arm length prices. So you cannot go beyond 5. Up to 5 arm's length prices we keep arriving, and then what we do? We take a simple average of all these prices to arrive at the arm's length price. In doing so, we also understood that there was a tolerance band. What was this tolerance band? Transaction price multiplied by 3%. Transaction price multiplied by 3%. Minus or plus will be the band within which it is acceptable. So the band that they will accept is that, suppose your price is 100 into 3% is 3 rupees. So from 97 to 103 will be the acceptable tolerance band. So if your transaction price is lying within this particular, your arm's length price, if it is lying within this band, then your transaction price will be considered as arm's length price. So what am I trying to tell? You first do the simple average. Take the 5 prices divided by 5. Add up all the 5 prices divided by 5. You will arrive at arm's length price. Now take the transaction price, apply 3% on the transaction price. Okay. So 100 is the transaction price, into 3% will give you 3 rupees. So if your transaction price, if your arm's length price is between 97 and 103, if your arm's length price is between 97 and 103, your transaction price of 100 itself will become arm's length price. Okay. So what did we tell? First take the average, then apply 3% on the transaction price, whatever is going to be the bandwidth, 97 to 103 for instance, should be your bandwidth of arm's length price. If arm's length price is, say for example, 102, okay, arm's length price that you arrived based on the average is 102, transaction price is 100 into 3%, so 103 is the acceptable band, 102 is also accepted, therefore 100 itself will become the arm's length price. If your arm's length price determined is within the band of this 3% of transaction price, then transaction price itself will become arm's length price. Suppose your transaction price is 100 and arm's length price is 120. this tolerance band will have no good, because 197 to 103 is where your arm's length should lie, but it is at 120. Therefore 120 minus 100 will become the adjustment that we'll have to take. Okay, so this is what we saw with respect to section 92C2. Then we went over to section 92C3, where we understood that there were 4 conditions when the assessing officer will be eligible to go ahead and determine the arm's length price. So what were the 4 cases? Case number 1, the most appropriate method has not been applied by the assessee. So point number 2 was that the data considered for the purpose of determining arm's length price was incorrect. So this is the second point. The third point is that failure to maintain documents and information as per section 92D, which we will be seeing today as to what is the requirement. Then 92D information is not submitted when it is being called for by the assessing officer. So in these 4 conditions, these 4 cases, what will happen? The AO will ignore, assessing officer will ignore whatever you have done as part of your transfer pricing study, and he will go ahead and determine the arm's length price. Now 92C4, what was it trying to tell? It told that wherever the assessing officer is going to go ahead and determine your transfer price, what is the consequence? Consequence number 1, he will not provide 6A deductions or 10AA benefits to the enhanced value. For example, your transaction price is 100. His transaction price is 120. Because of this, there is a 20 lakhs rise in the income. Suppose you are a 100% 10AA person. You are a SEZ involved in 100% export business. Now what happens? You are eligible for 10AA to the extent of export turnover by total turnover. Now he has raised your returned income. Your returned income is 1 crore. He is calling it 1 crore 20 lakhs. Now 10AA benefit will be available only for 1 crore, not for 1 crore 20 lakhs. The addition made by the assessing officer will neither be eligible for 6A deductions under chapter 6A section 80I income based deductions, or for 10AA benefits which are eligible for SEZ locations or SEZ units. Okay, so this was the point that we saw under 92C4. On top of this, where the income of one person was being adjusted, the other person's income will not be adjusted in that regard. For example, the cost for a person might get reduced because of arm's length application, but that will not reduce the income of the other person on whom the TDS has been deducted. Okay, so this was the next point that we had seen on 92C4. Now, we did not answer one point yesterday. What was that point? I was telling that up to 5 prices, if you have up to 5 prices from a particular transaction, you can take simple average. So let us take an example. What did we discuss yesterday? For example, I am having 4 prices: 100, 110, 120, 130. Okay, so this is these are the prices that I have. Okay, I have applied, for example, cup method. So I have applied cup method. I have 4 different companies with which I can compare my company. I can compare my company with 4 different companies, and for those 4 different companies, this is going to be the price. Okay, so now what will I generally do? I will take 100 plus 110 plus 120 plus 130 divided by 4. Okay, so now what am I doing here? This is going to be, let us say, 460, correct? So 460 divided by 4. So 460, just a second, 460 divided by 4. So the arm's length price is 115. So the arm's length price is 115. Now the transaction price is what? Transaction price, let us say, is 110. Transaction price is 110. So what will be the arm's length here? What will be the tolerance band here? The tolerance band will be 3.3 rupees. Tolerance band will be 3.3 rupees. So 110. So 106.7 to 113.3. So this will be the tolerance band. Now where is my transaction price? my transaction price is at 110, acceptable band of arm's length is going to be this, but what is my arm's length? 115. Is it within the tolerance band? No, arm's length is beyond tolerance band, so I will go ahead and call this differential 5 as addition to income. So this is what we have seen under section 92C2. Now, suppose in this scenario, if there is going to be 7 prices or 8 prices or 9 prices, because I have 9 comparable companies, so I do the entire exercise again. What will I do? I will take, supposing this is applicable for every company, so every company, and there is no restriction on number of arm's length price, what will happen? I will add, suppose 10 companies are there, add 10 prices divided by 10, I will arrive at what is called as my arm's length price. Now, there was a problem. What is this problem? See, transfer pricing is not a provision that applies only to India. It applies to every other country. It applies to every other country. So, if you see developed countries, they did not have this singular transfer pricing concept. For instance, in this example, what is the arm's length price? 115. So, there is a single price that is given as arm's length price. But when it comes to developed countries, for example, UK, USA, or any country for that matter, they did not believe in singular price concept or a point concept. So what they had in mind was a particular range concept. They had something called as range concept. What is a range concept? Instead of telling 115 as the arm's length price, the range concept wanted to tell, if your transfer price is between 110 and 125, then it is supposed to be at arm's length. So this is what was meant by range concept. This concept was not prevalent in India up to the year of 2014. So in Finance Budget 2014 or Finance Act 2014, our FM Mr. Arun Jaitley had brought in this concept called as range concept. So he brought in this concept called as range concept, covered by Rule 10CA. Okay. Now, what was the focus of this concept? This concept told, boss, transfer price cannot be a number. Transfer price can be within a range. Why can it be within a range? Because I don't compare it with one company. I compare it with multiple companies. Correct? So it cannot be a it cannot be a number. It has to be a range. Okay, and then they told there are only 4 methods. There are only 4 methods where this can be applied. What are the 4 methods? It can be applied on cup method. It can be applied on resale price method. It can be applied on cost plus method. It can be applied on transaction net margin method. So they told that this range concept cannot be applied on your profit split method. Okay, so only these 4 methods could be applied to. Why? Because the profit split method was a very specific method applying to co-venturers or joint venture. So the restricted applicability would not have those many comparables in the first place, and the comparables will also be very highly disoriented. It will not be very closely following one another. It will be highly disoriented. So it was not logical in bringing the range concept for profit split method. So they restricted this profit split method only to these 4 methods. Okay, I mean they restricted the range concept only to these 4 methods. So what are the methods? Cup method, and then your resale price method, transaction net margin method, and cost plus method. Only these 4 methods were eligible for your range concept under Rule 10CA. Now, let us understand what is this concept all about. Okay. What we'll do is we'll take up an example, an illustration, so that we will be able to understand how to apply this range concept. And this range concept is not something that is prevalent only in India, as I told you before. It was actually copied from developed countries. For example, USA or UK also have their own range concepts for transfer pricing study, and they also have limits which will set the start point or end point of the range. So the ranges are defined based on a start point and an end point. Okay, so now let us take an example to understand this. We will take up an example of 7 prices. Okay, I have done the transfer pricing study. Let us say under under cost plus method. I have taken cost plus method and I have done the transfer pricing study of Acer India Private Limited. I have taken Acer India Private Limited. I have done the cost plus method and I have arrived at the data for 7 companies, 7 comparable companies. Okay, so what are the price data? 185 for example, then 174, then 178, and then 169, and then 189, 192, 170. Yeah, so 1 2 3 4 5 6 7. Okay, so I have done the transfer pricing study for AIPL and I have taken 7 comparable companies. Based on the data that I have pulled up these as the transfer prices, okay, or the prices which they charge. Now I have arrived at 7 arm's length prices by applying the cost plus method for my particular assessee company. Now, can I apply section 92C2? No. 92C2 says ceiling limit on the number of price ranges should be 5. What is the number of price range that I have? 7. So this is called as a data set. What is this called? This is called as a data set. This data set has how many prices? It has 7 prices. Now I have to go ahead and apply the range concept only, because range concept applies, rule 10CA applies when there are 6 or more than 6 prices. What? 6 or more than 6 prices. How many prices do I have? 7 prices. Now let us see how to go about it. So step 1 will be arrange the data in ascending order. So arrange the data in ascending order. So based on the price data that we have taken, the starting point will be 169, then the second price will be 170, then the third biggest price will be 174, then the next price to be considered will be 178, then we have 185, then we have 189, and then we have 192. So 1 2 3 4 5 6 7. Yes, so the step 1 that we have to perform in these type of problems is what? We'll have to arrange the data set that we have obtained, that is the arm's length prices that we have obtained from comparable companies, in ascending order. So that is what we have done right now. Then step 2, ascertain 35th percentile of the data set. So what should we do? 35th percentile of the data set. Now the data set has how many prices present in them? It has 7 prices present, and the 35th percentile will be 7 into 35%. How much is that? 2.45. 7 into 35% will be 2.45. So that is the 35th percentile. Now, is this a whole number? No, it is not a whole number. So round it off to the next number, 3. Therefore, third number will be the starting point of the range. So starting point of the range is 174 rupees. So my range of prices will start at rupees 174. Now let us proceed with the next step. Step 3. Ascertain 65th percentile of the data set. So how many prices are there as part of the data set? 7. And then we have to find out the 65th percentile. So quickly computing that. So that is 4.55. Is this a whole number? No. So what should we do? We will take the next number. So 5th number, which is what? 5th price that we have is 185. Therefore, this will be the ending point of range. So what is the price? 185. Therefore, if transaction price within 174 to 185, then it shall be ALP. So what are we trying to tell? We found out the starting point of the range, we found out the ending point of the range. If the transaction price is anywhere within the range, the transaction price itself will be treated as arm's length price. So whatever transaction price you undertake will be arm's length price. For example, the rate at which AIPL has done the transaction, say, is 182. If it is 182, then yes, you are already at arm's length, because your range is starting from 174, it is ending at 185. You are well within the range, so it is 182. So it will be the transfer price, will be the arm's length price. Suppose my actual price is 194, transaction price is 194. What will be the arm's length price? What did we tell? If the transaction price is within the range, transaction price itself will be the arm's length price. Suppose transaction price falls outside the range, transaction price falls outside the range, then what will we do? Okay, I have not defined whether the transaction is sale, purchase, etc. As of now, we will assume it to be sales. So the selling price, transaction price, let us assume it as purchase price. The purchase price is 194. Okay, I have claimed it as 194. Now we need to find out what is the arm's length price, correct? So these are all purchase prices. These are all purchase prices. Purchase prices of the comparable company. Okay, case 1, my purchase price is 182. It is within the arm's length price bandwidth, so my transaction price will be arm's length price. Suppose my purchase price is 194. What should I do? I'll have to do step 4. What is step 4? Median of the data set. Median of the data set. What is median of the data set? 50th percentile. Okay, so 50% into 7, it will be 3.5. Since whether this is a whole number? No. Therefore, take the next number. What is the next number? 4. Therefore, this is the number we will take. Therefore, 178 equals arm's length price. So arm's length price is what? 178. Now that your arm's length price is 178, transactional price is 194, you will have to do an adjustment of 16 per unit. 16 per unit will have to be added back to income. 16 per unit has to be added back to income. So this is the application of your concept of range. Okay, the range concept. Now, sir, suppose the data set is even data set, sir. You have taken odd data set, sir. So for example, the data set is going to be even. Let us claim that there is going to be 20 price data. Okay, 20 prices. I have 20 comparable companies. I have done the transfer pricing analysis and I have arrived at the arm's length price. I have 20 prices. So what will be the 35th percentile? 35th percentile is equal to 35% into 20. That will be 7th price. So whether this 7 is a whole number or not, yes, it is a whole number. So can I directly take the 7th number? No, you will not take the 7th number. What you will do is 7th number plus 8th number divided by 2. This will be the start of range. So what will I do? In this question which we solved right now, we have 7 price data, which is an odd price data, correct? And whenever we took the 35th percentile and the 65th percentile, we had the benefit of what? We had what is called as decimals for the purpose of 35th and 65th percentile. Okay, even for that matter, up to 20, you will keep getting decimals. You will take the next data, correct? Now, if I am going to take 20 data sets, I have 20 comparable companies and I have taken the data, then 35th percentile will be an whole number. Okay, so the 35th percentile will be 7th price, correct? So I will not take the 7th price. I will do 7 plus 8 divided by 2. The average of 7th price and the subsequent price will give me the starting range. Likewise, for 65th percentile, so for 65th percentile, what will I do? I will take 65% into 20, that is 13. Whether this is a whole number? Yes. Will I take 13th? No. I will take 13th and the subsequent price 14th divided by 2, this will be the end of the range. This will be the end of the range. Okay, so this is what we will do. Now, suppose I have a price range of 10. I have 10 prices. Okay, I have found out 35th percentile, I have found out 65th percentile, and there is nothing that I can do with respect to the percentile computation, because 35th percentile will be in decimal, I will take the next number. 65th percentile will be in decimal, I will take the next number. Now, my transaction price is beyond the range. My transaction price is beyond the range. So what will I do? I will go to the median concept. What is the median concept? 50% or 50th percentile of the data set. So 50 into 10 is 5. Whether 5 is a whole number? Yes. See, in the previous example, when we did the median, we got what is called as not a whole number. We did not get a whole number. We got decimal here. So what did we do? We took the next number. Fourth price we took as the base. But in this case, what has happened? We have actually got a whole number here. So what will we do? We will not take the fifth number. We will do whatever we did over here. We will do whatever we did over here. So what will we do? We will take the fifth price plus sixth price, the average of fifth price and the subsequent price, sixth price divided by 2 as the arm's length price. Okay, so this is what we have to understand with respect to the basics of range concept. So let us quickly see what we have understood so far. The range concept is introduced in the year 2014. Sir, whether they will question on this? No, they won't. Okay, and Arun Jaitley introduced this. Whether they will question this? Definitely no, they won't. Now, coming to the more important areas, to what all methods is this applicable? It is applicable to every method but for profit split method. Okay, and what should we do? We should first find out the data set. The data set will generally be given in the question. This data set may comprise of number of prices 6 or above. So now, when there is going to be this data set that is given, the step 1 will be to arrange them in ascending order from the lowest to the highest number. So ascending order. After that, ascertain the 35th percentile. So 35th percentile of what? The data set. So if the data set has 9 prices or 7 prices, 9 or 7 into 35%. This will be the 35th percentile, which is the starting point of the range. Then you ascertain the 65th percentile. 65th percentile will give you the ending point of the range. If the 35th and 65th percentile are not whole numbers, you get decimals. Choose the next price. For example, here we have 2.45. Correct? This 35th percentile is 2.45. So it is not a whole number. We have taken 3, which is a whole number. Okay. So the next number is 3. 178 will be the starting point of the range. Then what did we do? We took 65th percentile. We got 4.55. Whether it is whole number? No, it is not. So take the next number, fifth number. So fifth number is going to be 185. 174, and then fifth number is 185. Okay, so this is going to be a range. So the range will be 174 to 185. If the transaction price is within the range of 174 to 185, transaction price itself will be considered as what? It will be considered as arm's length price. Suppose transaction price is beyond this range. Suppose transaction price is outside this range. Then what will we do? We will have to find the median. We will have to find the median of the data set. What is the data set? For example, in this question, the data set is 7 in number. Median of that is 50%, 3.5. Whether it is whole number? No. Therefore, take the next number, that is 4, and that will be the arm's length price. So 178 will be the arm's length price. Suppose this is a green scenario because everything was the entire data set was an odd number. Suppose the data set is an even number. Instead of 7, if I had 8 data sets, what would be the outcome? If it is going to be 8 data sets, then the following will be the outcome. What should we do? We will have to first do the same procedure. Arrange it in ascending order. Take the 35th percentile. When you do the 35th percentile, whether it is a whole number, 8 into 35% is not a whole number, it is still in decimals. So take the next number. Likewise, 65th percentile, take the next number. Now, if the transaction price is within this range, no problem, everything is good. Your transaction price is equal to arm's length price. Suppose transaction price goes beyond this range, then what should we do? We should take the median. Median 8 into 50% is a whole number. 4 is a whole number. You will not take the fourth price. You will take fourth price plus fifth price divided by 2, fourth price, that is the chosen price, median price plus the subsequent price divided by 2, average of the two will be the arm's length price. Now if the data set itself is going to be 20, what happens? 35th percentile and 65th percentile will be whole numbers. Can we directly take those numbers? No. What will we do? The number which is the 35th percentile and the subsequent number together divided by 2. For example, data set has 20 prices, into 35% will be 7. 7th price you will not take, you will take 7 plus 8th price divided by 2. This will be the starting point. Likewise, 13 will be the 65th percentile. So you will not take 13, you will take 13th price and 14th price divided by 2, which will be your ending the end of the range. Okay, so if the transaction price is within this range, it will be considered as arm's length price. Fine. If the transaction price is beyond this range, you will have to take the median of the data set. What is the median of the data set? It is going to be 20 into 50%, 10th price. Can we take the 10th price? No. You will have to take the average of 10th and 11th price, which will be the arm's length price. Fine. With this, the first point of range concept has been completed. So this is the first base of range concept that we have completed now. Okay. What I have done is I have given a problem in the attachment that is given in this particular video. It has a 20 price range problem. There is a problem which has 20 prices that have been given. So if you are interested, you can go ahead, try to crack it and come back to me. I have also given the transaction price in that problem. So the problem will have a price range of 20 prices and the transaction price will also be mentioned. 2 transaction prices will be mentioned. So you can check whether the 2 transaction prices fall within the range or outside the range, and then come back to me with the answers with respect to the arm's length pricing. Okay, that is a homework sort of a problem. So if interested people can revert to me with the solution once you have solved it. Fine. Now there is one more issue that cropped up here. What was this one more issue? These 3 methods, cost plus method, resale price method, transactional net margin method. Now these 3 methods had reliance on something called as profit margin. So cost plus method, resale price method, and then transactional net margin method. So these 3 methods had what is called as a margin. Correct? So cost plus method, what did it have? Normal gross margin. Here it had again the same terminology, normal gross margin. For T and MM, what did we have? We had net margin. Correct? So these 3 methods had this concept of margin. Comparable uncontrolled price, it did not have any margin, and when it came to your profit split method, this method had profit based on an agreement, not based on actuals. So there was a difference between these 2 methods compared to these 3 methods. What were the 2 methods? Profit split and cup did not have this margin concept, whereas the remaining 3 methods had this margin concept. Now what was the issue that they saw here? See, what am I doing in this range concept? I am taking the data of 7 or 8 comparable companies, arriving at the bandwidth, or I am arriving at the arm's length price. But when I resort to these 3 methods, what methods? Cost plus method, resale price method, transactional net margin method, I am also considering something called as a margin, which will not be the same for every period, correct? For example, this year I have a margin. The same margin need not be there for the next year. Same margin need not have been there for the last year or year before last. So people started telling that we'll have to consider a margin which would represent a period rather than taking margin of one particular year. Let us have margin of number of years so that we will get an average margin as the base before we conclude on the transfer price. Okay, so the department agreed with this. The finance ministry made the amendment in the following manner. They would take the weighted average of 3 years data. They would take the weighted average of 3 years data. So wherever these 3 methods were used for the purpose of arm's length price determination, and wherever the number of prices resulted was 6 or more. So these two conditions had to be there. First condition, you should have to go ahead with arm's length price determination using cost plus method, resale price method, transactional net margin method. 2, you have more than 6 prices that has been arrived at doing this particular exercise. Then what we will do, instead of taking only the data of the current year, we will take 3 years data as base for the purpose of determining arm's length price. Sir, what is this 3 years data? Good. So what is going to be the 3 years data? We will take profit level indicator. So what is that? Profit level indicator. So what can be a profit level indicator? Operating profit and operating cost. So what can I do? I will just do this operating profit divided by operating cost. Okay, year 1, year 2, year 3. I will arrive at operating profit for year 1, operating profit for year 2, operating profit for year 3. Likewise, operating cost for year 1, operating cost for year 2, operating cost for year 3. Then I will add everything and I will call it as total operating profit, total operating cost. So operating profit divided by operating cost will give me the weighted average percentage of one comparable company. So what will I do? I will tell that when there is a transaction between me and my associated enterprise, I can tell that the profit that I have earned is 25%. How did I compute this profit? I am telling that operating cost is going to be 100, profit is 25, revenue is 125, therefore 25 by 100, 25% is my operating profit to operating cost. Do not mix this up with gross margin. I am talking about profit level indicator. Okay, so this is going to be the indicator that I am going to tell them. Now what they will do, they will immediately go back and check comparable companies and do the same analysis, because operating cost, operating profit data will be readily available. With that, they will come back and tell what is going to be the operating profit by operating cost for comparable companies. Now this is not going to be a common factor for every year, so what we will do is we will take the average of 3 years. Can we take more than 3, sir? No, 3 is the prescribed number of years which we have to take. Now interestingly, if you see this range concept, which we take 35% and 65%, the developed economies generally tend to take a higher bandwidth. They start with 25%, go up to 75%. So the range starting point for US, UK or Germany, for countries like that, they start off with 25% and they end at 75%. So there is a larger bandwidth for these countries. Okay, and likewise here what we do is we take only 3 years data for the purpose of capturing the weighted average rate, but there is no restriction in terms of number of years to be considered. Okay, so this is what we will do. So what will we do in India? We will take the 3 years data. So 3 years data meaning current year, the year before the current year and the year before that. For example, I am doing the TP study for 2020-21. Okay, I will take data for this year, then 2019-20 and then 2018-19. I will take the data for these 3 years, add up the total operating profit, total operating cost, and then I will arrive at the profit percentage. Like this I will repeat for all the comparable companies. After that, I will have 7 sets of data. What is this 7 set? I have 7 comparable companies. For 7 companies, I have done this exercise. I will arrive at what is called as a data set. Now from this data set, we will rinse and repeat whatever we have learnt so far. Okay. Now, what has happened is, I have gone ahead and done this analysis. What analysis? I have identified 7 comparable companies. So my company has 7 companies which are comparable with in terms of business size, risk assumed, functions performed, etc. So I have taken these 7 companies data and I have arrived at their arm's length prices. Now I have found out that the method that I have used is cost plus method. So I have used cost plus method. So I am going to take 3 years data. Okay. Now, there is company 1. Data is available for this year, this year, this year. Company 2. Data is available for all 3 years. Company 3. Data is available for this year and this year, but data is not available for the 3rd year. Company 4. No data is available for the 1st year because company was not in existence. 2nd year data is available, 3rd year data is available. Now, company 5. No data is available because it was not in existence. This year it is available, this year it is not available. Now, which company will I take, sir? Which company will I take for the purpose of comparative study? I will take all the companies for comparative study. I will take all the companies. But what I will do is, I will take only the data that is available for the purpose of benchmarking. I will take only the data that is available for the purpose of identifying whether these comparable companies will give me the arm's length price or not. If data is available for 2 years, I will consider only 2 years. If data is available for 1 year, I will consider only 1 year. Okay, so this is how we do the range concept when these 3 methods are involved. Okay, what we will do is, let us take up a problem so that we will be able to understand and appreciate this particular thing better. Okay, now I have given a handout below, and we have a list we have one problem which is specific to this particular concept. Okay, take up the second problem. Now, what we will do is, I will sort it out for 2 or 3 companies, and I'll do up to 4 companies, maybe. Yes, 4 companies. Up to 4 companies I will sort it out. After that, you can take it up as a homework, solve it and get back to me. Okay, so now let us take up the first company, Dell. Okay, so here is year 1, year 2 and year 3. So operating profit, operating cost. What is the operating profit? For Dell it is 30, 35 and 40. Operating cost is 200, 300 and 450. So let us take the total. What should be the total? It will be 65, 40, 105, 500 and then 450, 950. Okay, so this is going to be the total operating cost and total operating profit. Therefore, what is going to be the weighted average? What is going to be the weighted average? The weighted average is going to be 105 divided by 950. 105 divided by 950. How much does that work out to? 9.05%. 9.05%. This is for one comparable company. This is the exercise done for first comparable company. Then second comparable company is ASUS. Okay, again operating profit, operating cost. So what is the operating profit? 45, 40 and then 55. What is the operating cost? 150, 100 and 150. So how much is the total here? 100, 140 and this one is 300 plus 100, 400. Therefore 140 divided by 400. So what is going to be the range? 2.86% will be the profit factor. Okay, so follow this and you will be able to crack the operating profit percentage for all the entities. What I will do is, we will straight away go ahead with Zebronics and TechZap. If you see Zebronics, what has happened? For year 3 data is not available, and if you take TechZap, first year it is not incorporated, so no data will be available. 3rd year data is not available, so only for the 2nd year data is available. So let us take Zebronics. So Zebronics, what is going to be the operating profit? 220.33 for year 1 and operating profit is 33, operating cost is 220, and for 2nd year Zebronics has 95 as operating profit and 375 as operating cost. Okay, so what is going to be the total operating cost? Total OC will be, total OP. Total operating profit. total operating profit is how much? 33 plus 95, 128. And then total OC, how much is it? 220 plus 375, that is 595. 128 divided by 595, how much is that? 4.65%. And then we have TechZap. I am not taking the rest because they are rinse and repeat of whatever we have done for Dell and Asus. Okay, TechZap has only one data set, which is 50 is the OP and 455 is the, this is not there in year 1, it is there only in year 2, 50 and 455. Okay, so how much is it? 9.1%. Okay, so like this you will have to determine it for all the 8 companies that are given there, Okay, now once you determine that, you should get a data set like this. Dell will have 9.05%. Okay, Asus will have 2.86%. HP will have 5.24%. Then Zebronics, and then how much is Zebronics? Zebronics is 4.65%. And then TechZap will be 9.1%. Samsung will have 6.27%. And Apple will have 5%. Lenovo will have 6.05%. Excuse me. So this will be the data set that we will have. So what is the number of data that we have here? So we have 8 arm's length price from comparable companies. So can we apply 92C2? No, because the number of price that we have here is beyond 5. So we will have to go with rule 10CA, apply the range concept. So what will we do here? We will once again follow whatever we have been doing so far. So what will that be? Step 1, ascending order. What will we do? We will have to arrange it in ascending order. So what is that? So in this range it is 2.86%, comma, the next biggest one is 4.65%. Then the next one is going to be 5%, then 5.24%, then 6.05%, then 6.27%, then 9.1%, then you are not 9.1, you have 9.05, sorry, 9.05%, and then 9.1%. So this will be the data set when it is being arranged. Now what will we do? We will have to take the 35th percentile. Step 2, 35th percentile. Now what is the 35th percentile? 8 into 35%. How much is that? It is going to be 2.8. So 2.8 is 35th percentile, or take the next number because it is not a whole number, third number. So the start of the range will be from 5%. So the range starts from 5%. Then the next step will be step 3, 65th percentile. So 8 into 65%, isn't it? 8 into 65%, how much is that? That is going to be 5.2, or we can call it 6, because 5.2 is not a whole number. We can take the 6th price. What is the 6th price? 6.27. 6.27. Therefore price range will be from 5% to 6.27%. So this will be the margin range between 5% and 6.27%. Suppose the transaction margin range is also within this particular range, it will be considered as arm's length price. If not, we'll have to go for the median. Median is what? 10 into 50%. So fifth price. What is the fifth price? 6.05. But can we take the fifth price? No. We'll have to take the fifth plus sixth divided by 2. So what is the fifth price? 6.05 plus 6.27 divided by 2. So that will be sorry. This is 4, not 5%. So the data set is not 10, the data set is 8. Sorry guys, the data set is 8. So 50% of that is going to be the fourth number. So fourth number. So can I take the fourth number? No, because it is a whole number. I will have to take the fourth price and the fifth price, the average of these two. What is the fourth price? Fourth price is 5.24 and fifth price is 6.05 divided by 2, which will be 5.645. So this is the percentage which has to be the arm's length percentage. Okay, so now what did we try to do here? We tried to understand the range concept when there are percentages involved. Why is there percentages involved? Because three methods involve themselves with percentages. What are they? Cost plus method, resale price method, and transactional net margin method. So what will we do? We will not take only 1 year's data. We will take the data of 3 years weighted average. How do we take weighted average? You will have to find out the profit level indicator. What is that? You will have to take operating cost, operating profit, add up all the operating cost, add up all the operating profits. Consolidated, that is total operating profit divided by total operating cost, is the weighted average rate you will get. Now identify all the weighted average rates. That will give you the data set. Now that you know the data set, you will have to take arrange them in ascending order first. Take the 35th percentile, which will be the starting point. If it is not a whole number, the next number will be the starting point, and then 65th percentile, see if it is the whole number. If it is not a whole number, the next number will be the starting point, ending point, sorry. So 35th will be starting, 65th will be ending. If your transactional margin is going to be within this margin, then it is the arm's length price. If not, what will we do? We will have to go and find out the median of the data set, which is the 50th percentile. Okay, applying the 50th percentile, we arrive at 4, which is a whole number. Do not take the fourth price. Take the average of fourth and fifth price, which will be the arm's length price. So the difference between transaction price and this average of fourth and fifth price will be the primary adjustment, or the adjustment that you have to make on account of transfer pricing. Is it clear? Now, surprisingly, the institute has never asked a question on the range concept. For some reason, they have not tested the range concept so far. And recently, that is for this attempt that you guys are writing, there has not been any amendments by so far. So there is chance that it might get tested. So I'm not going to tell that it will get tested for sure, but the chances of it getting tested are slightly higher because it has never been tested. Even if not so, there might be questions from MCQs as to identify the 35th percentile, or starting point of the range will be so and so. So you will have to apply 35th percentile and then conclude on it. Okay. Now let us try to understand some other points now with respect to the range concept. Now, AIPL has had 8 comparable companies, which is given in that problem that you have. Now, what has happened? 2 companies do not have current year data. Current year data is not available for TechZap and Zebronics. You have gone ahead. You have identified you have done the transfer pricing study, you have ascertained the income, you have filed the return of income. Now, knowing AIPL's history, it is picked up for assessment, it is referred to the transfer pricing officer. Now, transfer pricing officer, he goes through the entire study that you have done. he finds that there are two companies, Zebronics and TechZap, where current year data is missing. So what he does is he goes into the database once again, but by this time the current year data is available. What has happened? When the transfer pricing officer or the assessing officer is doing the assessment, now the data is available at their disposal. It was not available when you did it. Now the assessing officer has the power to include data of the comparable company and reascertain ALP. So what can he do now? He can now include that current year's data for TechZap and for Zebronics, which you left blank because you did not have data. He can now add it up and then check whether the range 5.645 which you have ascertained, whether it works out or not. Okay. After his application, suppose the margin becomes 7%, just for example, then that will be the arm's length price. Is it clear? That will be the arm's length price. Sir, whether it is revenue expenditure, let us not jump into the revenue expenditure point of it. Let us understand how this works. When it comes to revenue or expenditure, we can see how to apply it, whether on the upper side or the downside, etc. But that is not going to be tested at an examination level. The primary test is to see whether you have got the concept clear or not. Fine. Now, consequently, the assessing officer goes and does the assessment, and he says, boss, TechZap is a company whose turnover level is not even in sync with your company's turnover level and the other comparable companies' turnover levels. You have taken 8 companies. Every company has turnover somewhere around 600 crores. But TechZap alone has only turnover of, other companies have around 1000 crores. And TechZap has only 750 crores worth of turnover. So we feel that this is not a correct company to be included as part of comparables. So please remove this company. Whether the AO can do this? Yes. Wherever the assessing officer feels that a particular comparable can be removed by AO and redetermine ALP. So what can he do? First thing, if incomplete data is given and if he finds out that there is data to complete it, he can complete it and redetermine ALP. Who? The assessing officer. Case 2, he finds that a certain comparable is not going to be useful. It is not at all relevant. It has to be thrown out. Then he has the rights to throw out that comparable and complete the arm's length pricing only with the remaining comparable. Third case, in the due course, if he finds new company which can be a comparable, then he can include it. So what can he do? AIPL has 8 comparable companies, out of which 2 companies do not have data for the current year. He can, if at the time of assessment the data for those 2 companies are available, he can include the data of those 2 companies and then recompute the arm's length price. Case 1. Case 2, he feels that TechZap is a newly incorporated company. Its turnover levels are different, or probably the risk assumed or the functions performed are different. It cannot be a comparable. It has to be removed. So he can remove a comparable. Then he finds that XYZ Limited is a company which is more or less in line with the company which is under the assessment under the assessment proceedings. Therefore, you will have to include that company and only find out the arm's length pricings. So what all can he do? He can make an addition to the list of comparables. He can make a deletion from the list of comparables, and he can complete the incomplete data. And under all these 3 cases, he can redetermine the arm's length pricing. The AO can redetermine the arm's length pricing. Okay, sir, will this trigger section 92 C3 C4? No, don't go to all that. 92 C3 C4 is not the point here. During this range concept, if the AO finds out that there is a problem, 92 C3 happens when 92 C3 happens on specific circumstances. Here, this is not about inappropriate method, or this is not about going to have incorrect data. Everything is fine. Just that additional data is available which was not considered by the assessee, which the AO is trying to consider. And if the assessing officer feels that the contention of assessee for a comparable is not correct, he can remove it. That's it. Okay, so this happens whenever there is going to be a transfer pricing officer and assessing officer trying to redetermine arm's length price. So with this, the range concept comes to a close. Okay, so now let us quickly revise what we have seen so far. So section rule 10 CA has given us this range concept. So what is this range concept about? Where there are going to be more than 6 prices or 6 prices, then the simple average method which we have seen under 92C2 cannot be applied. So what will we do? We will arrange the data set in ascending order, find out the 35th percentile to be the starting point and 65th percentile to be the ending point of the range. If 35th and 65th percentiles are going to be decimals, it is not whole numbers, we will take the next number. So the number which is identified by this percentile will be the price that you will have to take. The number of that price will have to be considered as the starting price and the ending price. Now, and then if the transaction price is within this range, it is called as arm's length price. If the transaction price is outside this range, you will have to take the median of the data set. What is median of the data set? 50th percentile. So data number of prices in the data set into 50 will give you the per median of the data set. If it is a whole number, what you will do, you will take that number which is identified by the data set and the subsequent number and take the average of the two as the arm's length price. If it is not a whole number, you will take the next number as the arm's length price. Okay, so this is the range concept, and where there are only 3 methods involved, that is, you should not have cup method. You can have only transactional net margin method, you can have cost plus method, you can have resale price method. These methods have margins involved. So we will go ahead and take past 3 years data. We'll take past 3 years data, weighted average data, and we will ascertain the arm's length price. Once the margin for 3 years is ascertained, weighted average margin for 3 years is ascertained, then we follow rule 10C of ascending order, 35th percentile, 65th percentile, median, etc. Now, what else did we see? If the assessing officer finds that a certain comparable is not correct, he has the power to remove them. If the assessing officer feels that there can be an additional comparable in place, he can bring in that comparable and then redetermine ALP. Suppose he has found out that the comparable for which we did not have data, he has data, he can include the data and redetermine ALP. So these are the points with respect to range concept. Fine. I hope it is clear up to this. Now, let us move on to the next section. Section 92CA. Now, those who have actually done articleship in a tax firm, you would have seen orders, you would have seen assessment orders that would have come like this: 143.3 read with section 92CA. When you see an order like this, it means that order has a transfer pricing adjustment. What does it have? It has a transfer pricing adjustment. So what is this section talking about? This is talking about reference to a transfer pricing officer. So what has happened? AIPL has filed its return. AIPL has filed, Acer India Private Limited has filed its return. So after filing its return, the assessing officer has found out that there are following international transactions. Transaction number 1, sale to ASPL. Transaction number 2, R&D expense shared by ASPL. And then transaction number 3, lease of machinery by ASPL. So these 3 transactions the AO has found out from the return filed by AIPL. So what he does is he refers these 3 transactions to the transfer pricing officer, because AO transfer pricing is an area which requires some sort of specialization in terms of tackling how to determine arm's length price, whether the methods applied are correct, and what are going to be the comparable companies, etc. So the assessing officer cannot do it on his own, and so what he will do is he will refer it to the transfer pricing officer. So as I had told you earlier, there is an office in Greaves Road, Chennai, where you actually have the transfer pricing wing, where the transfer pricing assessments are done. So what will happen? The transfer pricing officer, on receiving the intimation from the assessing officer, what he will do is he will send a notice. He will send a notice to the assessee, and he will call for information. Now, what will the assessee do? The assessee will gather the information required by the assessing officer, and in this stage, please listen, in this stage, suppose I don't give him the information called for, then 92C3 will happen. He will go to determine the arm's length price by himself. Okay, so now this TPO gives the notice, he calls for information, I collate the information and I give the information to him. Okay, what actually used to happen earlier is that they used to call for a hearing as well. So the assessee will be given an opportunity of being heard. He will go submit the documents, attend hearings, and he will discuss the case to the assessing officer or the transfer pricing officer. Now, with November 2020 amendment that has been brought into the income tax laws, there is going to be a faceless assessment even for transfer pricing. There will be faceless. So what will happen is that the assessing officer or the NEAC, the National E-Assessment Center, will make a necessary transfer of this particular case, that is the transfer pricing case, to the technical units. These technical units will receive the case from them. They will call for the hearing required, the documents required. The technical units are the units which deal with certain specialized areas, for example transfer pricing. So what they will do is they will call for information from the assessee. The assessee will have to go to the income tax portal, submit those information. Okay, so after submission of those information, they will process through the information and they will check whether the arm's length price has been correctly identified or not. Now, what has happened? Let us not go into the faceless. See, faceless, when we do the assessment procedure topic, we will cover this part of the faceless assessment also. So as of now, we will understand the regular reference to transfer pricing officer. So TPO sends a notice, he calls for information, assessee submits all the information called for. Based on that, TPO finds that there are 5 additional international transactions. What has the AO referred? AO has referred only 3. On top of these 3 transactions, in addition to these 3 transactions, there are 5 transactions which the AO has not identified, but the TPO, transfer pricing officer, has identified. Can he go ahead and determine the arm's length price for those transactions? Yes or no? Yes, he can go ahead and determine the arm's length price for those transactions. Where he has found out that there are certain additional transactions, he can go ahead and find out the arm's length price of those transactions. Okay, so this is the additional power that is given to the transfer pricing officer. What can he do? He can call for information and he can also ascertain additional grounds and compute the arm's length price for those grounds. Now, when the TPO passes an order, TPO passes the order, he sends a copy to the AO, he sends a copy to the assessee. Okay, so now the AO, he is bound by the TPO's order, and has to include it in assessment order. So what will happen? AO has made a reference, TPO has started the TP proceedings, he has given the notice, he has collected information from you, he has found out 5 additional grounds are there, so he has taken 8 grounds in total and he has reascertained the transfer price, the arm's length price, and he is passing an order. In this order, he is telling that 10 crores should be added to the income. 10 crores should be added to the income because arm's length price was not correctly computed. Now, when the assessing officer passes the assessment order, and let us say that you have filed a return of income. You have filed the return of income with 12 crores as income. you have filed, let us not 12 crores, 112 crores. You have filed the return of income with PGBP of 112 crores. Not PGBP, total income is 112 crores. You have filed return of income, 112 crores is the total income that you have filed. Now transfer pricing adjustment made by the TPO, 10 crores. This will be added by the assessing officer, and then he will tell total income, assessed income will be 122 crores. This is what he will pass as a draft assessment order. He will pass what? As a draft assessment order. Because for the orders passed under section 143.3 read with section 92CA, there is a draft assessment order that is first given to the assessee. Okay, if the assessee is fine with the order, he will tell, yes, I am accepting to this adjustment, please pass the final order, and then the assessment officer will pass the final order, assessing officer will pass the final order. In case the assessee does not accept to this adjustment, he says, no boss, 10 crores can never be the adjustment, only 5 crores can be the adjustment, I can prove it. He says that he can go to some body called as the dispute resolution panel. He can go to what? Dispute resolution panel, which we will see as part of assessment procedure. Just wait till then. So there is a time limit of 30 days. From that time, they receive the draft assessment order. They have 30 days time before which they can go to DRP. If they don't go to DRP, it is deemed that they have accepted to the draft order and the final order will be passed. So this is the reference to the transfer pricing provision, reference to the transfer pricer by the transfer pricing officer by the assessing officer. So this is the provision relating to reference made by assessing officer to transfer pricing officer. Now, what is the time limit? Okay, now I have, let us say we will take for 21-22. Okay, we will take up what? We will take up 21-22 assessment year 21-22. So what has happened? I would have filed the return of income, and this is the date of filing, and this is 31st March 22, end of the assessment year. So from this period I have 9 months to complete the assessment. So I have how many months? From the end of the assessment year in which the return is filed, I have 9 months to complete the assessment. Okay. Now I identify that there is a particular there are some transactions in this particular assessee for which transfer pricing is applicable. So I immediately rush to the transfer pricing officer. The moment the assessing officer goes to the transfer pricing officer, the assessment time limit is enhanced by 12 months. It is enhanced by 12 months. Therefore, there is an additional 12 months. So total is how many months? 21 months for the assessment to get completed. Assessment to get completed is 21 months. So let us tell that from here to here is going to be 9. From here to here is going to be 12. So total time limit is what? 21 months. Now, when should the TPO pass the order? He should pass 60 days before. 60 days before the time limit for the final assessment order, 143.3 order, whatever is the time limit for that, 60 days before that, he has to pass the TP order. So TP order shall be 60 days before completion of assessment. So what is the time limit? This is only for AY 21-22, not before that. So for AY 21-22 onwards, what will happen? The moment I file return of income and the end of that assessment year, 9 months is the time I have as an assessing officer to complete the regular assessment, 143.3. Now, if I make a reference to assessment of a transfer pricing officer, this 9 months is enhanced by additional 12 months. So I will get 21 months in total. Okay, so now what will happen? I will go ahead and get the transfer pricing study done, and 60 days before the 21st month, the assessing officer has to give back the transfer pricing officer has to give the transfer pricing order. So when should he give back? 60 days before the 21st month, the transfer pricing officer will have to send the report to the assessing officer and the assessee, showing this is the order and these are the adjustments to be made. Now, if it is going to be for assessment year 2021 and 1920, these two assessment years, this time period of 9 will be 12. Therefore, plus another 12, 24 months used to be the additional time period that they used to get. So what are we trying to tell? For assessment year 2021 and 1920, 143.3 time limit was 12 months, and if you make a reference to transfer pricing officer, you get additional 12 months. So 24 months is the total time limit that is available. Now, for assessment year 1819, the initial time period was 18 months. 143.3 had time period of 18 months, and you had 12 months time given for the purpose of transfer pricing requirements. Therefore, it became 30 months for the purpose of the assessment to get completed. And before this period, it used to be 21 months for regular assessments and 12 months for additional transfer pricing reference. Okay, so it used to be 33 months. So why am I talking about these different time limits? Sometimes the question might specify the assessment years just to test whether the differential time limits are known, especially in MCQs. Okay. So what is the time limit? When it comes to 143.3 for 21-22 onwards, it is 9 months and additional 12 months for reference to transfer pricing officer. And for 1920 and 2021, it is going to be 12 months and additional 12 months for reference to transfer pricing officer. And this 12 months, 9 months, etc. When should we start computing these 12 and 9 months? From the end of the year in which the return was assessable. That is, the return was filed. The end of the assessment year in which the return was filed. For example, 18 March 18 is the end of the assessment year. So starting from April 18, you will have to compute this time period. Okay, so this is how we compute the time period. So this is the important time periods, that is with reference to the transfer pricing officer being referred to for the case of the assessee. Fine. So this is covered. This provision of reference to transfer pricing officer is covered under section 92 CA. It is covered under section 92 CA. Then we have one more section called as section 92 CB. This is called as what? Safe harbor rules. Now, the problem with transfer pricing was that often the assessees and the department kept fighting over whether this is correct, whether this is appropriate pricing or not, whether this is at arm's length or not. So CBDT wanted to have some sort of a standard in place. CBDT wanted to have a specific price which was going to set a standard, or which was going to set a benchmark as to what is the correct price that needs to be charged. So they came out with something called as safe harbor rules. What they started doing, they started dictating the percentage of operating cost to operating cost, operating profit to operating cost, or the percentage of profit that could be charged, and this was called as safe harbor rules. Okay, these safe harbor rules, generally when they are applied for 3 years. So the last safe harbor rules that was applicable in this fashion was assessment year 17-18. So for assessment year 17-18, 18-19, 19-20, these safe harbor rules would be applicable. Okay, so these safe harbor rules, if the assessee is complying with them, suppose let us take a software industry. Operating profit by operating cost should be 22%, for example. This is the safe harbor rule. And I am a software company, or Acer also has software division, and this software division is showing an operating margin of 22%. The assessing officer cannot question it. Assessing officer will simply accept with it and move forward. He will not try to redetermine arm's length price. So this was the power of safe harbor rules. So what did they do? They started setting up a benchmark. If the assessee is on that benchmark, the assessing officer will not question and he will simply proceed further. But for the financial year 1920 or assessment year 2021, they came up with the safe harbor rule which was applicable only for that year and not 3 years like what used to be the case with 17-18. So for this attempt which you guys are going to write, there is no safe harbor rules which you guys have to go through. So safe harbor rules for you guys is not applicable, where you have a list of items in a table specifying percentage which you have to remember for the purpose of application and examination. As of now, it is not applicable, and it is not also notified for the purpose of your examination or for the purpose for even practical applicability. So this is with respect to section 92 CB. Now let us move forward. 92 CC, 92 CD, we'll have to take it up in a separate session because that deals with a larger section which talks about advance pricing agreement. I thought of taking it today, but let us take it in a more detailed fashion in the next session. So we'll move on to the next section. So section 92D. What is D? D for documentation. See, documentation is a very important part of transfer pricing. If you see these big fours or probably even the second tier firms who are into transfer pricing, they get a chunk of their revenue from this particular operation of preparation of transfer pricing document. It's a very costly affair. Even for a normal company, the transfer pricing documentation is charged at the rate of 2 lakhs or 2,50,000 or 3 lakhs. So that is how remunerative this particular job of this transfer pricing documentation is. Okay, so if that is the case, let us take an example. My company has international transaction worth of only 10 lakhs. The value of international transaction in my company is 10 lakhs. Now I have to prepare transfer pricing documentation. The cost of documentation itself will be 3 lakhs. So is this even worth it? The cost of compliance becomes a burden to the assessee. So what the department told was, you need to have international transactions greater than 1 crore. Okay, greater than or equal to 1 crore for the purpose of application of section 92D documentation. So you will have the documentation to be prepared only if your transaction is going to be 1 crore and above. If it is going to be less than 1 crore, what is the point? You are only going to have additional compliance cost which is going to be incurred by you. Okay, so that was the first point that they wanted to emphasize on. Now, what is this documentation, sir? If you have seen a documentation before, it will be roughly around 80 to 100 pages. So what will they do? They will first talk about the group. They will give an introduction about the group about which they are dealing with, the MNC group, and then they will go ahead to tell who are all the associated enterprises in this group. So as per 92A, whatever we have seen, whatever clause is applicable, they will list out those clauses. Okay, and if the company has domestic transactions which are covered under transfer pricing, which we have not discussed, even those will be forming part of this documentation. Okay, please remember, whatever provisions we have discussed so far will apply to the transfer pricing of specified domestic transactions. What are they? Just wait, we will come to that. Now one more thing before I skip this range concept. When we do this range concept, will I apply the tolerance band of 3%, 1%? No, tolerance band will not apply, because the purpose of range concept itself is to have a range of price and not a single price. So concept of tolerance band will not apply there. So don't get confused there. Okay, now let us continue. So what will be there? There will be a discussion, there will be a small statement about the group as to what is the group about, and then they will have the list of the associated enterprises for the particular entity for which the documentation is prepared. Then they will go on to specify what are the list of domestic transactions which are covered under TP, what are the international transactions covered under TP. Then they will also discuss what are the companies chosen as comparable companies. They will list out the companies. They will tell that A, B, C, D, E are the comparable companies. The reasons for them being taken as comparable companies is as follows. They will specify that. Then they will tell that we have applied CUP method, RSP method, we have applied cost plus method, TNMM method, profit split method, and we have we have concluded the following. Against each method they will conclude whether this method will be applicable or not. For example, they will tell cup method cannot be applied because this business is unique and there is no uncomparable, uncontrolled transaction is not available. Therefore, applicability of cup method does not suit this particular transaction. The assessee is involved in manufacturing based on raw materials purchased from its parent entity and then only sells. There is no direct resale. Therefore, RSP method will not be applicable. Now, direct cost and indirect cost of comparable companies have been made available, and the normal gross profit margin is also available because the assessee company sells to outside third party customers also. Therefore, cost plus method has been chosen as the ideal measure. This is how the transfer pricing documentation will try to detail which method has been chosen and the rationale for choosing that method. After that, it will also talk about the profit level indicator. How to find out the profit level indicator? The operating profit by operating cost will be considered, and they will talk about the profit level indicator. And then it will go ahead and find out whether it will go ahead and conclude that all the transactions are at arm's length. This is the data that will be contained in this documentation. Okay, so this documentation you need not file with income tax return. You will not file it with income tax return. You will go to a big four, or you will go to a third party, you will go to a second tier firm or third tier firm, whatever be it. You will get the documentation prepared, keep it safely in your custody, because you are required to maintain it for 8 years. You are required to maintain it for 8 years from the end of that assessment year. Okay, now what will happen? Reference has been made to transfer pricing officer under section 92 CA. Now the TPO is telling, please bring documents under section 92D. That is when you will bring this documentation. He will tell, please bring documents you have maintained under section 92D. I will require it for conducting my TP study. This is the time you will have to go and respond. At this point in time, suppose you have not maintained 92D, then 92C3 TPO going ahead and computing ALP will trigger. Or he has called for the transfer pricing documentation, you have not submitted it, then he will go under 92C3 and start doing the ALP computation on his own self. Are you able to understand? So this is the importance of 92D. What are the most important points? First one, the transactional value of international transactions or specified domestic transactions should be greater than 1 crore. Okay, specified domestic, just keep it on hold. And then when it comes to the retention, it has to be retained for 8 years, and generally the details of the entire list of international transactions and the way in which the arm's length price is being determined, etc., is covered as part of section 92D. There is something called as master file and country by country reporting. This we will not handle it right now. Again, 2-3 topics I want to separately handle, because one or two has some amendments also which are applicable for the ongoing the upcoming November exams and for the May 22 and November 22 examinations. So we will handle them separately. So this master documentation, country by country reporting, we will take it up separately. So those also get covered under the ambit of 92D. Okay, so we have seen a reasonable amount of portion here. Now let us move on to the next section. So this is all about 92D. When we discuss about master documentation and CBCR, we will know more details with respect to the documentations to be maintained. Section 92E. Sir, all this is fine, but how will the income tax officer know what are the international transactions? He should know, he should have some starting point, right? Yes, the starting point is with respect to section 92E. What is this section? It is a report from a chartered accountant. It is a report from a chartered accountant, and it is not a report from an auditor. What is the difference? What is the difference between auditor and chartered accountant? My statutory audit of my company AIPL can be done by, for example, Sharp and Turner. Okay, so or Grant Thornton. Grant Thornton does the statutory audit. I can get the transfer pricing report from Deloitte Haskins and Sells because they are a chartered accountant and not my auditor. So this is a chartered accountant certificate. Therefore, I can get it from another chartered accountant also who is not necessarily my auditor. Okay, so it is a report from CA which has details of all international and specified domestic transactions. So it is a report from CA which has all international and specified domestic transactions and whether they are at arm's length or not. Okay, so this is what is covered as part of my report under section 92E. So this is a chartered accountant's report, and what is the time limit? The time limit is going to be 30th of October. This is the law stipulated time limit. This is this time limit stipulated by law, but you know that during COVID times the time limits are generally given some sort of relaxations. So as and when that happens, the relaxations will come into play. For example, for this year it will be 30th of November. For this year it will be 30th of November. Why? Because the return filing date has been extended up to 30th of December. So 1 month before the return filing date is going to be the due date for Form 3CEB. What is this? 92E, we will give a form called as Form 3CEB. The reporting date for that, the due date for that is 30th of October actually, but for this year, due to the extension and time limit given by the government, for AY 21-22 you can go up to 30th November. You can go up to 30th November. So this is with respect to section 92E. Now let us move on to the next section, section 94A. What is this section? Section 94A. Notify jurisdictional area, NJA. Okay, so what are these NJAs? So those who have done their articleship in tax based firms, you would have come across this treaties between India and other countries. This is called as double tax avoidance agreements. Okay, for these agreements to be generated or these agreements to be entered into, there should be a data sharing. There should be data sharing between two countries. So for example, if I remit money in Singapore, Singapore should be able to communicate with the Indian government telling that so many people from India have come and invested money in my country. So this sort of information sharing should be there between two countries. When this information sharing is done, they will enter into what is called as double tax avoidance agreements. But there are some countries which refrain from sharing information. For example, these tax havens. What are tax havens? The tax liabilities in those countries are very low, and then there are not very strong restrictions on cash transactions. So you can easily convert black into white using those countries. For example, Cyprus, then Bermuda. Okay, so these are some examples. There are other countries as well. For example, Mauritius. So these are considered to be tax havens, and the black money routing, even if you see in movies, they start sending it into other countries and bring it back into India so that they are able to call it as black converted into white without paying taxes on the same. So these notified jurisdictional areas are those areas which do not share information with India for the purpose of treaty formation. Now what has happened? Because of this, people started converting black into white. So what did they do? Let us say AIPL has some unaccounted sales. They have some unaccounted sales and the value is 50 crores. So what they do is they send this cash. They send this cash to X Limited in Cyprus. They send this cash to X Limited in Cyprus. They send it in cash. Now, assume that Cyprus does not share information with India. Assume that Cyprus does not share information with India. So, India does not know what money goes into Cyprus, how it comes from Cyprus, etc. Now, what will Cyprus do? Cyprus will once again pump in funds here. Okay, by calling it as investment. Probably into equity shares or preference shares or whatever. Now what has happened? This 50 crores worth of black money is converted into white. This 50 crores of black money is converted into white without 1 rupee of tax. Why? Because capital investment is not subject to taxation. So department started noticing these type of transactions. They told, fine, you have to come and understand something, that these countries do not share information with us. These countries do not share information with us. Therefore, even if the entity is totally unrelated to you, and if they are located in a NJA, and if you receive money or make payments, you will be deemed AEs. You will be deemed AE. What is the meaning of this? No capital, no directors, no intangible, no raw material, nothing. None of the 92A points will get satisfied here. 92A, none of the condition will be satisfied in this transaction. But still, what will be the outcome? These two will be treated as AEs, and the transaction will be subject to TP study. This will be subject to TP study. So what will happen? So this transaction is a 92B, international transaction, and these two parties are 92A, related parties. Therefore, I will have to go and check whether the transfer pricing provision has to be applied for arm's length or not. This is the penalization number 1. Suppose I make a payment. What happens? TDS at 30% to be deducted for payments to NJA. Suppose AIPL. So let us take an example. AIPL makes a payment to X Limited. Okay, pays 10 crores. Now let us take that, for example, this is going to be fee for technical services. So rate of tax is at 10%, and this is located in Cyprus, which is an NJA. For example, this is an NJA. Now the rate of tax itself is 10% under section 115A. But now what I will do, I will deduct tax at 30%. So minimum rate of TDS for payments made to NJA is 30%. Sir, income itself is taxable at 10%. I am not bothered. Please pay TDS, please deduct TDS of 30%. Why? Because this is a penalization for transacting with such type of countries. That's it. Okay. Now, this is the pressure point number 1. There is another pressure point with respect to NJA. What is that? Take up this example. Come back to this example. Now, in this example, the AO will go to the assessee and tell, explain how X Limited got that 50 crores. So what are they asking? Explain the source of income for the entity located in the national jurisdictional area, NJA. You will have to explain what is the source of income for that entity. Suppose AIPL is unable to explain or does not provide satisfactory explanation, 50 crores added to AIPL income. So what will happen? AO will come and question AIPL. Boss, tell me, how did X Limited get this 50 crores? I will have to tell, sir, they have been selling to so and so party. This is the business. Out of this business that they have carried out, they have got this income. We have got a mail from the MD of that company, and this is what the income is all about. And if that is satisfactory, it is fine. Suppose AIPL has not responded to this query at all. They have kept silent. Then this 50 crores will be added to the income of AIPL, and it will be charged to tax as if it is income of AIPL. Though it is capital of AIPL, still it will be treated as income. That is the penalization for NJAs. So what are the main points in NJAs? Any payment made to NJAs will generally be taxed at sorry, it will be subject to TDS at 30%, irrespective of whatever be the nature of income, nature of tax rate, type of tax rate, it will always be subject to TDS of 30%. Likewise, when an income is being received from an NJA, the source of that payment for the NJA, source of income for that NJA should be explained by the assessee. If the assessee offers no explanation or not satisfactory explanation, then that amount received, though capital in nature, will still be added to the income of the assessee and subject to tax. Is that clear? So this is the point with NJA. Sir, what is the NJA? Is there any NJA now, sir? No, they are used. Cyprus was considered as NJA as one point in time, and then retrospectively it was removed from an NJA, and there is no NJA as of now. But still the provision as such is still live. If there are additional NJAs that are identified in the future, and if they are added back, what will happen? We will have to comply with the provisions of section 94A. Okay, so this is with respect to section 94A. Okay, so this example will give us a visibility into why NJA is brought under the purview of transfer pricing. And please remember, any transaction with an entity in NJA, even if they are 100% unrelated, will be treated as deemed associated enterprises. The transaction will be subject to transfer pricing study. Okay, so this is with respect to section 94A.